All right, here we go. We got Corey Holstein, CPA. I'll call him the tax protector here. He's not the tax collector. He's the tax protector, helping you pay as little tax as possible over your lifetime to do proactive, forward-looking tax planning. Corey, welcome to America's Wealth Management Show. Great to have you here.
Yeah, appreciate you having me, Dean.
Hey, we're talking. We got the deadline, the supposed deadline, right? The April 15th deadline. It's approaching, and people might be going, "Oh my gosh, I got to get all my stuff. I got to get it to my CPA, and man, if I don't get it to him by X date, I'm going to have to file an extension. And oh no, that extension might cause me to have a higher risk of audit. Or man, I really have to get this done. I've never had an extension before. What's it mean?" Corey, this extension's not a big deal. And we're going to talk about that today. And we're going to talk about things that you need to know about filing for an extension. So how do you want to set the stage here, Corey, on what people need to know when they start talking about, hey, I might need to file an extension, and we're trying to get a tax return done for everybody, trying to get it done by April 15th, but we don't necessarily look, Corey, at April 15th as the deadline. What we want is time and accuracy and making sure that we've done everything possible to help mitigate as much tax as possible. So why do we focus more on that than the April 15th deadline?
Yeah, to your point, Dean, the April 15 deadline, while it is important and we need to make sure we hit certain metrics when we get to April 15th, it's not the be all end all. And there actually may be some opportunities by waiting beyond April 15. It may actually, there are some certain areas of the tax code where it extends certain things like how much can I contribute to different HSA accounts, or if you're a business owner, like a SEP account, it gives you a longer opportunity to make those contributions. Make sure we're being diligent about any tax planning moves going forward. Make sure we utilize everything within that tax code for optimization there.
So you don't have to file your return by April 15th, but there is a couple of critical things that have to be done by April 15th. What are those?
Yeah, Dean, the main one here is we have to apply for an extension. Make sure you tell the IRS, hey, here's what we plan to do. We did not get things squared up by April 15th. We filed for an extension. That's really step one, to say, give us an extra 6 months here. Push that deadline to October 15. Now, that doesn't mean give my documents to my CPA on April 1st or October 1st now, but it does just letting the IRS know that, hey, we are requesting another 6 months to get this return filed. The other key here, Dean, is make sure you have all your taxes paid in. So even if we don't necessarily know all of the information by April 15th, there's a lot of people who are missing forms yet by April 15th. We need to have a good estimate about what our income was for the previous year to make sure all of those taxes are paid in by April 15th.
Yeah. And Corey, you're going to have a pretty good idea, especially now they don't really have a good idea of what the tax bill is. It's important that you actually file for that extension, because if you just don't file your return and you don't file an extension, what happens?
Yeah, so the penalties are actually a little bit different for you, Dean. So instead of having just a failure to pay penalty, you actually get a failure to file penalty, which is much more significant. So when we look at unintended consequences, or we look at how am I paying more taxes than I should, penalties is the layup answer. We don't ever want to be paying penalties. So when we look at the failure to file penalty, that's actually a 5% penalty on whatever you owed per month, up to 60% there. So this is a significant portion here of, hey, let's make sure we get this filed. If we got the extension filed and we still owed taxes on April 15th that we never paid, that penalty cuts down to 0.5% per month, up to a 6% penalty there. So we are talking about a 90% difference in penalty cost just by doing the automatic extension, which is a very simple form for your CPA to fill out. It does not require a signature from you in order to file it. So if you're traveling, you can't get to the office, you don't know how to do DocuSign or whatever equivalent your CPA is using, this is an easy way to just push out an extension, mitigate some costs associated with having to file that extension.
Corey, what happens in, let's say, the event of, let's say you got a couple that's traveling together, it's February, April, March, whatever. They get in an automobile accident, both pass away. and the tax deadline is for the prior year is still April 15th. Obviously, something's going to happen here. Are there exceptions to this for something like that?
There are some exceptions to the rule, some protections in place for situations like you described. Natural disasters is a big area here as well, where they will actually waive the requirement to file an extension, those sorts of things. I would say let's plan don't plan on utilizing those things, but know that there are some exceptions to the rules for certain unique situations there.
Well, I just know, Corey, that, like, for an example, we might have an individual that is their cognitive ability to decline. Maybe they're coming down with Alzheimer's, and now they're in a memory care unit, and they got put in towards the end of last year, and they have no idea, right? And if that person hasn't really done everything that they need to do, and they don't have a trust or maybe a successor trustee or somebody that is helping them out, that person could run into some real issues. How do you deal with that type of thing?
Yeah, so I can only speak from my perspective here, Dean. So what if we haven't heard from you, right? Let's use this same example. I haven't heard from this individual, and it's April 1st. You haven't sent me a single document. I've called, I've emailed, I haven't heard a single thing. I will go ahead and just file an extension. I don't have any information to know what you owe, but at least I can mitigate some penalties that way. So reach out to your CPA is probably the best answer. Whether it be you or a beneficiary or someone else who's involved in the situation, just reach out to the CPA, explain the situation, ask for the extension to be filed. That at least puts some safeguards around. Otherwise, we do have to request some type of waiver on the penalties due to unique circumstances when that return does get filed.
And that's something where you would actually have a conversation with the IRS on behalf of one of our clients, right?
Yeah, certainly can have that conversation, or you can simply file an additional form and request abatement for this as well. So there are a couple different ways that you can go about solving for that problem. Actually calling the IRS on your behalf requires a power of attorney. So there's a few other steps there, but this is something we would certainly do on behalf of a client.
All right. Later on in the program, we're going to talk about this audit myth. I mean, there's a lot of people are always worried about, oh my gosh, I'm going to get audited. Corey, I've been audited more than once. It's not fun, but it's not a normal type of a scenario either. There aren't a lot of people that get audited each year. There maybe are some things that might throw up some red flags that might trigger an audit, but I think what people think might trigger audits are different than what might actually trigger an audit. And Corey, we're gonna tease just a little bit there, and you and I are going to talk about that later. And you can talk about what could cause an audit and some myths of what people might think cause an audit that might be surprised at how that works. And then obviously later on in the program, we've got our Don't Do That segment, and we'll explain why estimating 0% on the extension that Corey just talked about could be a red flag and could lead to immediate penalties. But first, let's look at the mechanics of how you file this extension, Corey. What exactly does it do? Walk us through the form that you filed. The extension is 4868. Talk about that, Corey.
Yeah, so the 4868, Dean, it's basically a summary form of what you think your tax return is going to look like. All it really lists here, Dean, is here's what I think my income was, here's what I think my tax was, here's how much taxes I've already paid. I either am projected a refund where I don't have to pay anything with the extension, or if I project that I owe, here's the payment I'm going to make to coincide with that deficit there. So it's a pretty simple form. It's just one-page document. It does not require a signature from the client. It can just be filed simply from the CPA without any real work to be done by the individual.
And what about for the state, Corey? What is that? Does doing this form 4868, do they communicate with the state that you're in to let them know that you're filing an extension as well, or do you have to do something there?
Yeah, so this is a state-by-state issue here, Dean. So the state of Kansas, where we're in, it's an automatic extension. If you filed it for the federal return, you don't have to actually file anything separate for the state. But every state's going to operate a little bit differently there. So just make sure you understand your state rules, that if they require a form as well, make sure you're getting that side submitted at the same time. And
then you have a golden rule when it comes to filing an extension. What is that?
So the golden rule here, Dean, is something I alluded to earlier already is, hey, just because you requested an extension of time to file does not mean that you requested a time to pay. And the IRS does not give you an extension to pay. They say you had 12 months to get this all paid in previously. We gave you another 3.5 months to get it paid by April 15. It's due on April 15. So the key here is have an idea of what we may owe and be conservative. So estimate a little bit high on whether it be the income side, or if you calculated $1,500 of taxes due on your return, maybe make a payment of $2,000. When you go and file that return in July, August, September, you're going to get that $500 difference back as a refund.
And there's this saying that you pay in safe. Okay, what does that mean? You pay in safe. There's a couple of different rules that surround that. What are those rules, Corey?
Yeah, so when we talk about paying in safe, there's really two different ways that we could look at that. There's a paying in safe of throughout the course of the year, whether it be through my withholdings or whether it be through quarterly estimates. I paid in safe to the point where I didn't incur penalties for the income that I made. And there's a couple different ways you can look at this. There is the 90% rule. And what this says is I have to have 90% of my current year taxes paid in on time. So if my taxes for the year was $10,000, I either needed to have $9,000, 90%, either paid in through even quarterly estimates or through withholdings in order to avoid penalties. That's option number one.
And that and the time frame of that is January 15th, correct?
That is correct. Yep.
So there's another date that's important to have that paid in. It's not by the time this April 15th of time to pay isn't it. If you didn't have that 90% paid in this example, Corey, by January 15th, you're already racking up penalties.
Yeah, and that's what we'd consider an underpayment penalty, which is different than our failure to file or failure to pay penalties. So there's
I love the IRS, man. This is fun. This is really fun.
And penalties, again, to reiterate, this is what we need to avoid. That's an easy answer to say I'm overpaying my taxes because I just didn't do it right. So that's example one, right? This 90% rule of my current taxes, I have to have them paid timely. Option number two to be paid in safe is 110% of last year's taxes paid. So the example here is maybe I made 100,000, my taxes are 10,000, just to use an example here. But now this year I got a big increase in my income. I'm going to make 200,000. Okay? Well, in order to be paid in safe, I only need to pay 110% of last year's taxes. So even if my taxes might be 20 or 30,000 this year, they were only 10,000 last year. So to be paid in safe, I have to pay 110% of last year's taxes, or $11,000 by January 15th, either through withholdings or quarterly estimates, in order to be paid in safe.
Yeah, so Corey, I want to tackle that really quick because this is where I think people can miss it, right? Well, gosh, I'm going to owe $20,000 this year. I need to have 90% of that paid in by January 15th. But if you only owed $10,000 the year before, all you got to do is have $11,000 paid in by January 15th. You get to keep $9,000 of your own money earning interest all the way until you file your return on April 15th, right? So you get to put a little extra dollars back in your pocket.
Yeah. So the general rule of thumb here, Dean, is if my income is going up, generally speaking, I'd pay 110% of last year's taxes because that will be less than 90% of this year's taxes. If my income is going down, I would generally want to pay 90% of my current year taxes in order to avoid those penalties and optimize what you're talking about there of the time value of money. I could have left this money invested for longer and got a return on my investment, as opposed to the 0% tax interest rate that the government will give you on your refund.
I want to go on to this one just a little bit more, Corey, because I think a lot of people might get surprised here. But I would see scenarios where we might go through a year and we took advantage of some gains. We sold some things because we were afraid maybe the market was going to turn against us or whatever, and we created some significant capital gains in a year, and that person wound up owing some tax when they filed their return. And then what the CPA does is they're like, well, now you need to start making estimated payments of this much larger amount. And they don't understand that, hey, that was a one-time event. And so when they're doing that, basically they're doing the first option of safe pay, which is 110% of what you owed last year. when income may be significantly lower, and they need to have a conversation because, man, you shouldn't be doing that, right?
Yeah. So every year is a different landscape. And to your point, the situation you described is a one-time event. It's not something that's going to be a recurring thing each and every year. So one of the things that we do here when going through the tax preparation is we say, what does next year realistically look like? And which of these two options is better for us to make payments? Now, when you do that, you want to also still be careful, right? Still estimate a little bit high than what you might normally do, because it's still important that we get the 90% of the current year taxes paid to avoid those penalties.
Yeah, I just say it used to drive me crazy, Corey. Whenever somebody would say, "Well, I got to pay all these estimated payments," I'm no. Well, but my CPA, they gave me this form. They said I got to send these checks in. I'm like, no, stop. We're not sending anything in, right? I know what your income is going to be this year because I know everything. I'm your financial planner. All they know is what you reported last year, and that's where I think that's just really, really critical. And this is where I think, okay, every individual, Corey, doesn't take the time, and I don't blame them, to really understand the tax code and how it all works. Great, okay. And Corey, so it's clear that ghosting the IRS is the worst possible option. Sometimes people avoid filing because they're afraid of asking for an extension or make them look suspicious. Is this real? Is this a myth? What actually causes an audit? Because a lot of people think, well, if I'm going to file an extension, that means that red flags are up, and boy, I'm at a higher risk for an audit. What's the truth, Corey?
Yeah, so let's even break down what an audit really is, because we have several clients who will receive notices, and we will have maybe a client here or there get an actual audit. So when we think about something like a notice, this is just a letter generated from the IRS that went out to the client, the taxpayer, that says, hey, either something's wrong, our records don't match, you owe X, or actually your refund is Y. So this is a very common thing. And the reality of how the IRS operates today is most of this stuff is computer driven. So either the records don't align perfectly, the computer reads that, and it triggers a correspondence. That is very different than an audit. Now, nobody likes to receive anything from the IRS. The key here is don't panic. Reach out to your CPA, get advice about what happened, what's the discrepancy, is it actually correct? Because there have been several times where we've caught things that the IRS didn't have the records coded appropriately. I'll give you one example. I had a client make a payment of significant money for quarterly estimates, and they coded it to her deceased husband's social security number. Well, that was $10,000 that was paid in that the IRS basically lost track of. And we could verify that the payment was made appropriately and on time. So always reach out to your CPA. Don't just assume the IRS has the right answer, because they make mistakes too. Now, when we think about something like an audit, nobody wants to be audited. But I tell everybody also, unless you're committing fraud, you don't really have to be concerned about an audit either. It's a headache. It's a pain. Nobody wants to experience it. But unless you're trying to hide something from the IRS, an audit isn't something to be afraid of. Now, when we look at something like an audit, again, I'll reiterate what I said earlier here. Most of this stuff is driven by computers. There are millions of returns filed to the IRS every single year. There is not a person in the back room looking at every single one of these returns and saying, I'm going to pick this one for the audit. And so what the computer's looking for is discrepancies compared to the normal. So one example I'll give here is charitable donations might be an audit flag for somebody, because maybe their income is $100,000 and they gave $60,000 to charity in 1 year. That is outside of the normal situation that the IRS is going to see or what the computer is going to read. That is in itself an audit risk. Now, an extension of a tax return is not what I would consider an audit risk. It would be a little bit riskier to file an incorrect return on time than it would be to make sure you have all of the data in there appropriately, where the computer reads everything. There's no real unusual events happening here, and the return goes through just fine. So inaccuracies, unique circumstances that are outside the normal situation, those things actually will slightly increase your audit risk. But again, should I use the same charitable example of $60,000 on $100,000 of income? If that's the right move for that taxpayer, and everything's above board, there's nothing to fear about the IRS looking at the books a little bit closer there.
And I think the reality of an extension, Corey, is in a lot of cases it can be a good thing, right? Because it's giving the CPA more time to make sure that everything is buttoned up and it's 100% accurate. As long as you've got what you paid in and you've done the safe pay, like what we talked about, one of those two options, whichever one is right for you, that extension is not a bad thing at all. In fact, it might be a good thing. And like I said, I've maybe filed on time once in the last 20, 25 years, but because I'm always looking for that extension. Okay, let's make sure that we've got everything, and that we're, again, not just looking at last year, but we're looking at this year and the following year, and we're really coordinating and trying to make sure that we've got everything buttoned up.
Yeah, and I'll even add to that, if you own a small business, let's say it's a Schedule C business, and maybe you want to make a SEP contribution. Well, by filing an extension, that gives your CPA to make sure that the books are accurate, that the Schedule C is prepared appropriately, and that 6-month extension to file the return also applies to your SEP contribution. So it allows you to do the math and just come up with the cash and say, yeah, I'm going to make this SEP contribution before I even file my return. The same thing would apply to an HSA contribution. So maybe I didn't have the cash right on April 15th. I made my tax payment, but I still want to make this HSA contribution. Filing an extension might be the right move just in order to come up with the cash to make those different types of contributions that'll actually mitigate taxes over the long term. The other key here that I do want to bring up is when you look at, there's some ways to be advantageous about how you make your extension payment as well. So if you are filing quarterly estimated tax payments, oftentimes what I will do in order to be conservative is, let's say you owe $2,000, your quarterly estimated payments are $5,000 a quarter. What I'll do is say, okay, the first quarter estimate of $5,000 is due on April 15. The $2,000 is due on April 15. So one of the things I'll do is I'll say, hey, let's just write one check for $7,000. That guarantees that even if we were off on income and maybe I actually owed $2,500, well, I paid $7,000 in. And when I go to file that return, what I'll do is I'll take the refund, in this example of $4,500, and apply it to your quarterly estimates for next year. So this is a little bit of a workaround to say, I'm only writing one check for my quarterly estimates and my tax payment due, and it solves the problem of I'm not incurring penalties because I'm way overpaying my previous year and planning to use it for next year. So that is one little trick there for extension payments with quarterly filers.
Corey, let's talk about the quarterly filer, and let's talk about that person as it relates to somebody needing to take an IRA distribution. Let's call it an RMD. Let's say that a person has got their Social Security, they've got interest and dividend, maybe they've got a pension, they've got their Social Security, and they've got maybe some rental income, right? So they've got all the income they need, and they're not relying on their IRA to live, right? And so there's a couple of things here that I want to point out. That person may choose to do the quarterly estimates like what you're talking about. Okay, so this is what we think you're going to owe. But if they wanted to keep all their money all year long and then pay everything in December, there's a way to do that. And the way to do that is, you know what your RMD is, you know what you're going to owe. Well, you can direct that IRA custodian to withhold as much as you want out of that IRA. And when you do that, that's considered a withholding. So that withholding all of a sudden made all of those quarterly estimates null and void. So let's say you had a total tax bill going to be due of $20,000 throughout the course of the year, Corey. You could take an RMD of $20,000 and you could have the whole $20,000 withheld for federal tax. And you don't get anything. All of it goes to the IRS, but that prevented you from having to pay $5,000 per quarter. Am I thinking about that the right way?
Yeah, you are. And just to even elaborate on it more, because the question I'll get a lot is, why do I have to pay these quarterly estimates? How does this make any sense? And the easiest way to say it is it's a matching principle. So when you take the income, you have to pay the taxes accordingly. And if you don't have withholdings, right? If you're not a W-2 person anymore and they're not just taking the taxes out on your behalf, you're incurring income throughout the year. You have to pay those taxes evenly throughout the year. which is where this quarterly estimate system comes up with. But withholding is always treated as satisfying that matching principle. The $20,000 in your example, Dean, of the required minimum distribution is income. So it doesn't really matter when the withholding happened as well, because the income was at the same time. So in your example of $20,000 just going in and being paid from the required minimum distribution, that satisfies the matching principle. It says $5,000 of that was paid each quarter, even though you waited until December 15 to make the full payment. From the IRS's perspective, that does not matter.
Now, why is that important? Because you get to keep that $20,000. That adds up over time. And that's just a strategy of payment, of how you pay. And it's not anything to do with real tax planning, but it's something that can be effective.
Yeah. And here's the other reality is the quarterly estimates aren't an easy schedule to even remember. When you think quarterly estimates, you would think every 3 months. No, it's April 15, June 15, September 15, and then January 15 of the following year. There's no real system to the process there, which means it's easier to make mistakes when you're writing the quarterly estimated payments as well, which can trigger more penalties if we forget to make a certain payment. So any chance I have to do the withholding method, I'm going to look to do the withholding method.
But again, if the CPA is not working with the CFP, how do they know what that R&D is going to be that year? They don't, right? So just stop guessing with your taxes. Corey, time for the don't do that, the $0 extension. We teased on that a little bit earlier, and I said, hey, this could be a red flag. If you do that automatic extension, but you estimate that your tax is zero over what you've already paid in, why would that be a red flag?
Yeah, so it's a red flag because the IRS says you didn't put any effort in, right? You didn't even try. You didn't give us any real information here. And so when the IRS sees a situation like that, they can actually say, hey, you really didn't file an extension. You didn't do the minimum standard to get to that point. And they can go back and assess the penalties a little bit differently, where they may charge you that full 5% per month. So it is, when I described that earlier, Dean, it's not something I would like to use often. It's really more for those unexpected events of someone passed away or dementia sets in and we don't know what's going on. It's a get out of jail free card at times, but it is not a strategy I would look to implement often here.
Yeah, there's just so many things, Corey, when it comes to taxes, when it comes to our tax code, when it comes to all the things. And we look at this, and I've been saying this for years and years and years here on America's Wealth Management Show, is that as long as you live in the United States and you either have money or make money, taxes are going to be a fact of your life. And what you need to be thinking about every year is not just how do I pay as little taxes this year, but you should be thinking about how do I pay as little tax as possible over a lifetime. And you know what? The rule book is complex. And if you don't understand the rules, that's where you start overpaying your taxes. Corey, I know you got a few closing tips for our listeners and viewers here. What are they?
Yeah. So Dean, the keys here that I would want to reiterate for people is start your return early. Now, we've talked through why an extension is not necessarily a big deal. It's not a problem. It's not an audit risk. A lot of the common misconceptions around the estimate. But if you don't, or around the extension, if you don't want to file an extension, start early. Provide your information to the CPA up front. Things have gotten a little bit more difficult where consolidated 1099s are getting pushed later and later, longer than they have been in the past, where we've got some consolidated forms coming on February 28th. Give your CPA all the other information on February 1st because you have most of that information. So start the process early. Be easy on your CPA. They're doing hundreds and hundreds of tax returns. So get them that information up front. We work through that information. When the final form comes in, it's just putting a bow on the return at that point. Tip number 2 here is keep some cash on hand. So one of the things that surprises people is, I owed more than I thought I did. I didn't budget appropriately for this. I've got to go into my investments in order to get some cash. Well, Dean, this takes a few days to get through this process of we got to sell a position that generates the cash. Now the cash has to hit the bank account. Don't put yourself in a bind by having too little cash on hand. Prepare ahead for what you might owe. And again, do that forward-looking tax plan so there aren't surprises to begin with. The other tip here is make payment a few days before the April 15 deadline. Unexpected events happen, right? There might be an issue with the payment where maybe the check doesn't clear, or maybe there's a glitch in the system as far as getting that payment out on time. Make sure you schedule that payment before April 15th, because the IRS does not give a lot of grace for payments after April 15. There's that 5.5% penalty because you didn't pay by the April 15th. The IRS has also changed some of its guidelines around when a payment is considered timely. So you have to have that payment postmarked by April 15. If you drop it off at 10 o'clock at night in the mailbox, that's not on time anymore. And so make sure you're proactively doing these things a few days in advance. Get the money out appropriately there. And the last thing there is one of the things that we talked about earlier, Dean, of when you're looking at your current year tax return, it's a great time to ask yourself what's going to change in the next 12 months. So don't way overpay on your quarterly estimates. Do an actual projection about where you think your income's going to be. Was there a unique circumstances that existed in the previous year that won't happen again in the current year? Make sure you're really doing that tax plan, really thinking about where my income's going to go, and set up those quarterly estimates appropriately while you're already thinking about taxes.
Corey, great stuff as always. I really appreciate you taking time out of your busy schedule, especially during tax season here, to share your expertise with our viewers and listeners. Ladies and gentlemen, thank you for joining us here on America's Wealth Management Show. I'm Dean Barber along with Corey Holstein, CPA, and as I call him, the tax protector. Until next time, everybody stay healthy and stay safe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.